Hi, I'm Brad Sugars and welcome to the Business Basics. In looking at buying, building and selling companies, the buying is very important. We've covered that one. There's a bunch of videos here on the build, and now we've got to look at the sell. How do we actually sell a business and make sure that we reap the rewards of doing that extra work of building a company? Well, there's four main strategies that you'll come across to when you're selling a business. The 4 F's, I call them. You can flog a business, which is essentially the quick sell. You can finish a business, which is to get it to a point where it runs without you and then go for maximum value. You can float the business, take it to an initial public offering and sell shares on the public stock market. Or you can franchise the business, go out there and build the business through franchising where people buy parts of the business in their area of the world. Now, looking at all 4 areas of selling a business, there are some fundamental facts that need to remain the same, but each of the strategies, again, has different areas within it. So let's take a look at the float strategy then. The float strategy is, well, initial public offering, IPO. In many countries it's called different things. Taking a company to a point where you've built it, you've built up a good solid business, and now that business is something you're going to take public. Now, you don't want to do this on a small business. It's got to be done on a larger business. If it's not doing, 30 to 50 million in revenues and 2 to 5 million in bottom line profitability, it's generally not going to be worth doing. When we take a look at it, it's going to cost generally between $250,000 and $500,000 to actually put this sort of a document together to make it happen. And then you're going to have to pay brokerage fees on the amounts raised. It's got to really be something worthwhile for you to do a strategy such as this. I think in many cases, it's something that you have to understand that it's just going to be out of the reach of a lot of small businesses. Where we get to ultimately, though, at level 5 entrepreneur on my entrepreneur's ladder, that's ultimately where we want to be doing these sorts of strategies. So there's 4 main reasons why people will use the float strategy. The number 1 reason is to raise capital. Now, in many cases, raising capital is not about selling the business, it's about getting future cash to actually make the business worth more money. But it does help with selling out because it actually puts a valuation on the shares. There are publicly traded shares, so any shares that you own could fairly easily be valued, and therefore fairly easily you could make the sale of the business. You've got to have a good reason, though, to raise the capital, because otherwise why would the market give you capital if you didn't have a real reason to actually use the capital and go out and get results with it to keep the business growing? Very simply put, if I'm raising capital, there's probably several things most investors are looking for, not just what is the business and what is its ability to grow, but who is the board, who are the people behind the business is going to be a very important part of it. I personally wouldn't do one of these if it wasn't trying to raise at least 10 million. I don't think that there's enough value in doing it for less than that. It's too much work, too much energy and too much effort. And too much risk as well, I guess, is the other point if you're going to do it. Next, move on to selling down. Now, this is one reason people use a public float. I personally think this is a very bad idea. I think selling down your shareholding by going to the public market and selling off a bunch of your shares to the public is not a good idea at all. Then again, I am a bit of a control freak and I do like to control things, and having someone else have a big say in how I run my business is generally not going to be something that excites me. So, in most cases, I personally think, for me personally anyway, I'd be better off if I actually sold the whole thing rather than trying to just sell down a share and take some cash out. Probably better to do it with a venture capitalist in that way rather than float the business. Next thing we've got to look at is people sometimes will do the float strategy just to get a valuation of their business. So they might float off only 5% of the business. Famous examples of this, UPS doing it, where they float off 5% of the company. And you say, well, what's the use of floating off 5% of the company? Well, it's purely done to just get a valuation on the company so that we can see what those 5% of shares are worth. But it's an inflated valuation because if there's only 5% of the company available for sale and a lot of people do want to be involved in it, then obviously it's going to inflate that valuation quite substantially. If the other 95% of the shares were put on the market, I can guarantee you it would be a lot easier to get, and therefore the share value would go down. Finally, the 4th strategy is to actually sell out. Look, selling out of the business through a public float is, in my case, a very good idea if it's planned well. You know, if you plan it well, I think you can pull this off extremely well, whereby you actually remove yourself from the business. Now, you may end up holding 10 or 20% of the company just as shares in the public company, but in most cases, you'll need to bring in the professional management, you'll need to bring in those people that will add value to it from the perspective of the potential buyers. If we follow this, we understand there's two forms of float strategy, being the valuation of the company and selling down, that are generally not great ideas or great reasons to float the company. Generally, to sell out or to raise capital are the two main reasons we would use to float a company. And how can I put this? Very simply put, there's a heck of a lot to learn to float a company. You need to use professionals, and it's always far better off when you do. I'm Brad Sugars, and these are the Business Basics.